We're tracking the death of the dollar in real time. Not the headlines, not the hot takes. The actual map, trade flows, reserve shifts, payment rails rewiring themselves while you sleep. Every week, another country announces a bilateral currency swap. Another central bank quietly diversifies reserves. Another commodity gets priced outside the dollar system. The architecture of global finance is being rewritten, one transaction at a time. The question isn't whether it's happening. The question is what it means when the world's reserve currency bleeds market share but refuses to die. And what breaks when the erosion finally reaches critical mass. And here's what most people miss. Currency dominance isn't binary. It's not dollar versus yuan, winner take all. It's a slow erosion of market share, a gradual repricing of risk, and a world that's learning to route around a system it once had no choice but to use. And every percentage point that shifts away from the dollar represents trillions in lost leverage, economic, political, and strategic. We're going to walk through 3 case studies that show you exactly how this works. Not theory, actual trade desks, actual treasury decisions, actual friction in the machine. Then we'll talk about what it means for you, because this shift shows up in your costs, whether you're watching or not. The paradox of power, falling share, persistent dominance. Here's the ground truth. The dollar holds 59% of global reserves as of 2024, down from highs above 70% in the early 2000s. It accounts for 88% of foreign exchange transactions. The Chinese yuan, just 2.3% of SWIFT payments versus the dollar's 43% and the euro's 32%. The euro sits at 20% of reserves, the yen at 5%. There's no close competitor. Price is a negotiation, settlement is a system, and systems don't pivot because a press release said so. The scale gap matters more than headlines suggest. U.S. capital markets are worth over $50 trillion. The Treasury market alone processes $600 billion daily. China's bond market, while growing, faces capital controls that limit foreign access. You can't build a reserve currency on restricted convertibility. The infrastructure, clearinghouses, custody chains, legal frameworks took decades to build and stress test. But the real question is, why is the share falling at all? Sanctions risk reframe the safety premium. When reserves can be frozen, central banks diversify fast. The 2022 freeze of Russia's $600 billion in foreign reserves was the watershed moment. What looked like a financial weapon to Washington looked like existential risk to Beijing, Delhi, and Riyadh. Overnight, SWIFT exposure transformed from a convenience into a single point of failure. Reserve managers from Jakarta to Brasilia started asking the same question. If it happened to Russia, could it happen to us? So we see experiments, bilateral lines, alternative messaging, local currency settlement. The map lights up with pilots and partial pivots. Yet the experiments reveal brutal constraints. Russia's yuan holdings surged, but what can Moscow actually do with them? China's capital controls mean those reserves can't easily convert to other assets. Russia can buy Chinese goods, invest in limited Chinese instruments, or hold the yuan and hope. That's not a reserve currency. That's a trade credit with extra steps. And when the music stops, you're left holding paper you can't spend. True reserve assets need 3 qualities: deep liquidity, full convertibility, and legal certainty. The dollar has all 3. Alternatives have 1, maybe 2. Let's look at how this plays out in practice. Not in theory, but on actual trade desks, where real money is on the line, where people are trying to move goods, settle payments, and hedge risk without getting crushed by basis, spreads, or liquidity gaps. Start with India and Russia. After sanctions tightened, rupee accounts were set up to keep goods moving. On day 1, it looked like a clean workaround. Invoice in rupees, settle through special Vostro accounts. Keep dollars out of the loop. But trade imbalances created a traffic jam that turned into a bottleneck. Russia, running a surplus, accumulated rupees it didn't really want. By mid-2024, Russia held billions in rupees with limited options. Buy Indian goods it didn't need, invest in Indian assets with repatriation restrictions, or negotiate steep discounts to convert back to harder currencies. India's capital account isn't fully open. The rupee isn't freely convertible. Russia couldn't easily rotate those balances into infrastructure elsewhere or park them in deep bond markets. The result? Discounts, delays, and a search for side doors into more liquid currencies. Some Russian oil sold to India at steeper discounts just to avoid rupee accumulation. The workaround worked, but with friction that ate into the supposed savings. Every transaction became a negotiation. Every settlement carried hidden costs. The system functioned, barely. Case study 1, BRICS and the local currency workaround. China and Brazil expanded direct RMB settlement for bilateral trade, linking it to China's clearing banks and swap lines. For Brazilian exporters, RMB settlement promised faster access and fewer fees. The 2023 agreement to settle trade in yuan and real looked like a clean pivot. But the RMB makes up just 2.3% of SWIFT payments. Converting RMB into global assets isn't straightforward. Capital controls, quota systems, and a shallower bond market introduce convertibility risk. Here's what that means in practice. A Brazilian soybean exporter receives RMB payment. Great. Now what? Hold it in a Chinese bank account earning limited yield? Convert it through approved channels with quotas and documentation? Invest in Chinese bonds that can't easily be sold if you need liquidity, or pay a spread to swap it back into dollars or reals? Each option has costs. The treasurer runs the numbers and realizes the savings from avoiding dollar intermediation get devoured by conversion friction, FX basis, and opportunity cost. What looked like a discount on paper becomes a premium in practice. Brazilian treasurers weigh better trade prices against harder-to-hedge currency exposure. Many split the difference, partial RMB, partial dollar, because optionality beats purity. The data shows it. China-Brazil trade grew, RMB settlement grew, but dollar settlement didn't disappear. It shifted from 100% to maybe 70 to 80%, with the rest in RMB. That's diversification, not replacement. Now scale that friction across the entire BRICS bloc. Russia reports that around 90% of its trade within BRICS in 2024 was settled in national currencies. That sounds like a revolution, until you look at what happens next, when those balances need to move, hedge, or convert. Let's talk liquidity gaps, because this is where theory hits P&L hard. In thin markets, bid-ask spreads widen and forward points move against you when stress builds. Take a real example. A Southeast Asian manufacturer sources materials from a BRICS country in local currency. The spot transaction is smooth. Then they need to hedge 3 months forward. The forward market for that currency pair barely exists. The bank quotes a 200 basis point spread versus the 5 basis point spread on a dollar hedge. Suddenly, the savings from local currency settlement vanish into hedging costs. The arbitrage looked clean on the whiteboard. On the trading floor, it bleeds. Basis risk shows up when your input costs are tied to one currency, your revenues to another, and your hedge curve is shallow. A south-south trade financed in local currency looks clean until a shock forces you to roll hedges at bad levels. Then the apparent saving evaporates. Treasurers remember pain. They default to the deepest pool. Trade imbalances compound the problem. Surplus nations need a store of value. Local currencies with capital controls won't do it. They want liquid, enforceable claims with predictable duration, something you can sell on a bad day without moving the market. That's why treasuries remain the resting place for excess savings. China holds over $800 billion in U.S. treasuries despite geopolitical tensions. Why? Because there's nowhere else to park that size at that liquidity. Until an alternative offers equal or better liquidity and legal confidence, the flywheel keeps turning. BRICS can settle trade in local currencies. That's real. But converting those balances into globally deployable reserves, and that's where the system still runs through dollars. The plumbing hasn't changed, just the invoicing on the surface. And plumbing is what matters when the pressure spikes. Case study 2, Russia-China reserves and the sanctions shock. The 2022 sanctions turned theory into a live fire drill. Over 16,000 restrictions hit Russia, the most sanctioned country in the world. The freeze of Russia's $600 billion in foreign reserves, assets held in Western banks and central banks, redefined what safe meant overnight. Risk-free stopped meaning low volatility and started meaning free from seizure. Reserve managers from Beijing to Riyadh to Delhi rewrote their playbooks in real time. The rules of the game had changed, and no one was waiting for permission to adapt. The sanctions were comprehensive. Exclusion from SWIFT for major Russian banks, asset freezes on the central bank, restrictions on technology imports, a price cap on Russian oil enforced through insurance and shipping bans. The coalition, US, EU, G7, and allies, aimed to crater the ruble, trigger capital flight, and strangle Russia's ability to finance its war. The ruble did spike from 87 to 102 per dollar initially, but Russia's countermeasures stabilized it faster than expected. Russia moved first because it had to. By 2024, roughly 90% of its trade with BRICS partners settled in national currencies. Official reserves tilted toward gold and RMB. Energy flows pivoted, more barrels settling in yuan, with receipts looping back into Chinese accounts. Payments routed through China's cross-border interbank payment system CIPS and bilateral lines. The point wasn't efficiency, it was optionality. But the costs were brutal. A Bank of Finland study found that the median price Russia pays for Chinese exports of sanctioned goods rose 87% between 2021 and 2024 versus just 9% for non-sanctioned countries' exports. Ball bearings, critical for industrial and military use, saw unit prices roughly double. For tapered roller bearings, prices nearly quadrupled. Overall, sanctioned products cost Russia about 40% more than comparable non-sanctioned goods. Russia could access what it needed, but at a steep markup that bled fiscal resources dry. Sanctions didn't cut off supply, they just made survival expensive. China became Russia's dominant trading partner, accounting for about 30% of Russia's exports and 50% of its imports by 2025. Yet Russia represents only about 3% of China's exports and 5% of its imports. The dependence gap is enormous. Russia has few alternatives. China has many. That asymmetry gives Beijing leverage on pricing, payment terms, and political concessions. What did that do to the map? The RMB's presence in reserves rose incrementally, and gold's share climbed across several central banks. Direction is clear. Scale is contained, for now. Why? The RMB makes up just 2.3% of SWIFT payments versus the dollar's 43%. The bond market is growing but shallower, with capital controls. China's onshore bond market is large in nominal terms, but foreign access is restricted by quotas, regulatory approval processes, and repatriation limits. That limits how much balance sheet global dealers will commit. Convertibility and depth still matter, and when crisis hits, depth is everything. Meanwhile, Russia's energy revenues took a hit, a big one. New U.S. sanctions in 2024 targeted Russian maritime oil exports, the shadow fleet, insurers, and shipping networks. Combined with lower global oil prices and the need to offer discounts to Asian buyers, Russia's oil and gas revenues in 2025 are projected to fall about 24% below what the government assumed in its budget. The fiscal pressure is crushing. Russia can sell oil, but at lower prices through more expensive channels with higher transaction costs. The sanctions didn't cut off trade. They made it more expensive and less profitable. A slow strangulation, not a quick kill. Chinese banks also pulled back under secondary sanctions pressure. A December 2023 U.S. executive order threatened secondary sanctions on foreign banks, facilitating Russia's military-linked trade. By mid-2024, about 98% of Chinese banks stopped accepting direct payments from Russian companies. Trade didn't stop. It routed through smaller banks, non-bank channels, and increasingly complex structures. But transaction costs rose, processing slowed, and large Chinese banks avoided high-profile deals like they carried contagion. The financial isolation was partial, not total, but it added friction at every step, and friction compounds. Case Study 3, Saudi pricing and the petrodollar pressure point. Riyadh is the hinge. The petrodollar system, established in 1973 after the Nixon shock ended dollar-gold convertibility, cemented the dollar's role by requiring oil sales in USD. In exchange for weapons and military protection, Saudi Arabia agreed to price all its oil exports exclusively in dollars. By 1975, all OPEC countries signed on. This created the petrodollar. In place of a gold standard, the world had an oil standard. Demand for oil created structural demand for for dollars. For 50 years, this system held. If Saudi Arabia prices even a slice of crude in non-dollars, the ripple hits screens you never see but still pay for at the pump. Fragment the benchmark, raise basis risk, and every downstream hedge gets more expensive. The petrodollar isn't just a pricing convention, it's the load-bearing wall of dollar dominance. The 2025 IMF Article 4 consultation confirmed Saudi Arabia's currency peg to the dollar remains appropriate and is backed by strong reserves. Yet reports of yuan-denominated oil talks with China and expanded infrastructure ties test the edge of that system. Saudi Arabia became the largest emerging market dollar bond issuer in 2024, with total issuance around $200 billion, 5 times 2015 levels. The kingdom issued conventional bonds, sukuk, and green bonds, diversifying instruments but staying anchored in dollar markets. Vision 2030, launched in 2016, aims to reduce oil dependence and diversify the economy into tourism, entertainment, logistics, and technology. Non-oil real GDP growth is projected at 3.4% in 2025. The fiscal deficit is expected to peak at 4.3% of GDP in 2025, then narrow. All of this is financed through dollar markets and backed by the dollar peg. Yet reports of yuan-denominated oil talks with China test the edge of that benchmark. Pair those with local currency pilots, swap lines, and deepening infrastructure ties. On paper, it's optionality. Keep the dollar door open, build a second exit. In practice, traders ask, can they hedge size daily at a tolerable cost? Here's the mechanism and why it matters. Today, Brent, West Texas Intermediate, and Dubai-related markers clear through deep futures and swaps markets, dollar-denominated with enormous open interest and continuous liquidity. The NYMEX and ICE futures markets process millions of contracts daily. That depth lets refiners, airlines, and producers shape risk across tenors, 1 month, 6 months, 2 years out. With tight spreads and reliable execution, it's a machine built over decades. If Saudi barrels start clearing in RMB or a multi-currency slate, you create parallel curves. Parallel curves don't match perfectly. The gap between them is basis. Basis drifts when stress hits. That drift is P and L pain. And it compounds fast under pressure. A refiner buying yuan-priced crude now needs to hedge commodity risk and currency risk. The commodity hedge might reference a dollar benchmark with a basis adjustment. The currency hedge runs through a separate forward market. If those two markets move out of sync, and they will during volatility, the combined hedge breaks down. Spreads widen, costs rise. The refiner either absorbs the cost or passes it to consumers. Here's a refinery treasury micro story. They run scenarios for dual currency hedging. Some feedstock priced in yuan, some in dollars, output sold in mixed markets. They map cross-currency basis, commodity basis, and the liquidity profile of each hedge tenor. In quiet markets, the blended book is manageable. Then a supply shock hits, maybe a Middle East disruption or a sudden Chinese demand surge. The yuan leg's forward points jump as onshore liquidity tightens. The commodity leg moves on a different timetable driven by physical supply. Basis eats the margin they thought they locked. The treasurer realizes they're not hedging one risk. They're juggling 3: commodity price, FX rate, and basis between the two. And when all 3 move against you at once, the hedge becomes the loss. Next quarter, they go back to the supplier and demand a discount for RMB invoices to compensate for the hedging complexity, or they revert to dollars for the portion they can protect against with standard tools. Optionality survives. Purity doesn't. The market learns that multi-currency invoicing works for stable flows and small size, but stress exposes the cost brutally. That's why adoption stays partial. The system bends, but it doesn't break. Practical segment, hedging a slow motion shift. The slow motion shift creates friction, not crisis, at least not yet. Your risk isn't hyperinflation or a sudden dollar collapse. It's rising transaction costs, wider spreads, and more expensive hedges that show up as higher prices for goods and services. Death by 1,000 basis points. Map your exposure. Look at where your spending touches global trade, imported groceries, fuel, travel, software subscriptions. If invoicing diversifies across currencies, spreads creep into prices silently, steadily, until one day you notice everything costs more and no one can explain why. Diversify cash equivalents across jurisdictions. Keep a neutral sleeve like allocated physical gold. It answers the seizure question and sits outside any single jurisdiction. Add selective foreign assets, international equity funds, foreign bonds. Keep bond duration short if funding costs rise. Write a pre-mortem. What if your primary bank loses access to SWIFT? What if your currency gets caught in a sanctions crossfire? Map the scenarios and set up fallback options before you need them. Because when the system breaks, there's no time to build a lifeboat. Conclusion. The dollar isn't dying. It's losing market share in a world that's learning to root around it. That shift is real, measurable, and accelerating. And it shows up in your costs whether you're paying attention or not. The question isn't if the system changes. It's whether you see it coming before it arrives at your door. Subscribe for more.